don't give your money to active managers. Doesn't matter what the track record is, doesn't matter how well they've done. You cannot, well, they say you can't buy conviction.
I wish it were that simple, but here's the thing. Help me understand this. The people involved in this include the most brilliant, financing minds in the world.
You're also exhibiting like a good investor behavior here because you're down like more than 40% on that position, but you're not just going, oh, I'm down, I'm going to add to my loser.
I buy that. Yeah, I could see, though, when this will happen. Like in 5 years, I could see the quality of auto rides being so much superior to driving your own self, both logistically and financially, that eventually, right, it's going to be illegal to drive.
For an advertising-free version of this show, check out wallstreetwildlife.com.
Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Krzysztof the Monkey Piekarski. This week on the show, we're going down the rabbit hole with 3 more King of the Jungle stocks. Krzysztof is going to tell us about Procept BioRobotics, and I'm doing a head-to-head comparison of Tesla and Uber. Plus, Krzysztof's going to give us an update on the very complex and confusing EOS Energy rights offering. We did a segment on that just for Patreons. If you're in patreon.com/wallstreetwildlife, you will have early insight, but we want to give some updates to everybody on the podcast. So hang on for that at the back of the episode.
Indeed, Badge. So since we last talked, you came back from your motorcycle trip, and are nesting safely in your carefully manicured, green-lawned British compound. And as per our conversation, you also took a side trip to see a little bit of tennis on those fine green lawns that the Brits love so much. How was that?
Great. Yes, it's super Wimbledon this year. Yeah, we managed to get super last-minute tickets. Katrina and I went on Thursday, a few days ago. So we saw both the ladies' semi-finals plus the mixed doubles final. It was a great day out. Wimbledon's always a brilliant day out. You know why it's really good? It's actually really good value. And if you can get tickets in the ballot, they're actually really reasonably priced, like a few £100 for like literally a world-class top flight sporting event. Plus, you can take in like a picnic and 1 bottle of champagne per person. So basically, like I'll have a glass of champagne, Katrina guzzles 2 bottles, and then I just like pound down good beer in plastic cups, and we have a fabulous day out.
Yeah, that's wonderful. I'm jealous. I've never seen tennis played on the grass. I've only been to U.S. Open, and I imagine it must feel very, very different.
Yeah, I guess it's slower, I suppose. Not really a tennis expert. I do play, but not very well. And the one time I played on a hard court, I got my ass handed to me. I didn't realise completely how different it was. So that was my friend Christine who surprised me with like these like wild balls that were flying much flatter than I expected.
Well, here, Badge, on my end, I've been living quite an interesting life in the past month or so. I haven't really talked much about this, but I really got serious about learning Italian. There's the mucking around like you do on the Duolingo. But I've been trying to really push my edges, and I've been putting in like 6 hours a day of really, like forcing myself to come up with words from memory, and the hearing part, and there's the dialect issue in Sicily, or when as a language learner it feels like everybody's talking too quickly, and my ears don't work that well, so I also don't hear as well as most people, so I have an extra challenge of really catching what a certain word is. But I've really been going deep, and it's an interesting life because it's like a difficult thing you do every single day for many hours, but I think the results are starting to come in. Like I'm legitimately hanging in conversations. I could understand them in the native way mostly. Speaking is still like there's still a major Like, you know the word, it's in there. I could recognize it, I could understand it, but to get it out from zero is kind of in with no thought. That's the fascinating thing about language acquisition. But
is like your household now an Italian speaking household to force you to think?
Well, Miss Monkey is fluent, so
Right.
so there's that. But here's
Are you talking like Italian over the breakfast table?
you know how it is. If we really want to communicate, I can't. Takes me too long. So no. But here's the interesting thing. I did use AI to create for myself an app. I built my own app that forces me to practice verb conjugations. As an Italian, you're learning Spanish. It's the same thing. And in Italian, there's like 11 different cases, 6 different conjugations per verb, each one a little letter off. And it's incredibly confusing if you haven't been learning it since a kid, right? It's just an overabundance of info. So I built myself a little practice app, and it's actually quite effective. Every day I quiz myself, made a bank of 50 verbs that are the most common, plus explanations. I was like, this is pretty cool. So no need to pay for an app that I just made myself. So maybe that'll be inspiring to some of our listeners. It's actually kind of cool.
Yeah, awesome. Good job.
Yeah, thanks.
Well done. I'm rubbish at languages. I've made the effort, but I need to do what you're doing. Like I was in Spain recently. I was talking about hanging out for like an extra week and dropping into some kind of Spanish class. But in the end, I got terrified by the heat wave and just like scampered back to London. But that is something I want to do at some point.
Yeah, I mean, really, I think the only way forward for me, because I always go back to the United States and you know how quickly you forget, I have to force myself to find a way to communicate, like to practice speaking every day or multiple times a week. There's no other way. There's no substitute for real dialogue. But that takes effort. Maybe I'll find a group, live Italians in Austin conversation group or something. Badge. So anyway, using my brain, it's hard doing it the real way. But I have to say this again. The Duolingo thing at this point with the power of AI. So I don't know. People are still really talking about that. I mean, it's still massive valuation. I wonder. I really wonder.
Totally agree. Like so on the Spain trip, I used a buddy's Duolingo, he has like Duolingo Max, but he's like learning Italian as well. And so an app Max is like, pay the most and you get like a video call with Lily and like you can do stuff and it's a bit more engaging. And I had a crack at it. It's not that impressive. Like it's like, I tried with my poor Italian, I tried to take the conversation in slightly different directions, but it keeps you like super narrow focused on, that thing was about, she wanted to talk about what music do I listen to? And it doesn't understand. I mean, my pronunciation's probably BS, but Google Translate understands me better. And like from my own experience, like they've never had a dollar of my money. If you have a mistake in a lesson and you can say, explain my mistake, and that's available to free, the explanations are not very good. They're not very contextual. They don't really tell you why you got it wrong. So what I'm finding almost every day is I'm taking a screen grab, I'm dropping it into Claude or Gemini, and I'm just saying, explain this. So yeah, Duolingo is like it's bullshit.
It's, as I said before, the way I'm handling this now, I'm doing two. An AI program I made myself, plus forcing myself into really difficult live human conversations. I don't see the Duolingo path is neither of those.
It's entertainment. We're going to end up doing a Duolingo segment here, and neither of us really know anything about the company. We just, we're chatting about the experience. It's quite good as an app. Like I am coming back to it every day for a couple of minutes. But I think I read some observation a couple of months ago on X that it's not like a language learning app. It's just like an entertainment app. And I think that's probably accurate.
Right. Yeah. I mean, I'll say this one more time, or maybe differently. There is legitimate pain I'm experiencing when I'm in a real conversation with a native where I feel like why can't I say the right thing even though I know the words? It's kind of embarrassing, and then there's this like, am I too dumb? I can't. But in the end, it's none of that. It's like language is this thing you embody, you really embody, and it's too an organic thing, and you just have to put in the reps. You say a phrase 40 times, and eventually you don't have to think about it, right? But there's no shortcut to it, is kind of the point. It's like live by pain, and Duolingo doesn't fix that. So anyhow, Badge, there's this Fundsmith problem. I don't know if that's the right way to say it. Tell us about what Fundsmith is and what's happening.
I could only go super deep on this, but what's happened in the last couple of weeks just kind of reinforces a very strongly held opinion I've always had. So Fundsmith, it's a fund. It's like an active, if I keep it really simple, like an actively managed fund started by a guy called Terry Smith, who's like ex-London City veteran. And he launched this boutique asset manager in 2010. And I first heard about it because my brother had like a Fundsmith allocation in his own portfolio. And I'm not a funds guy, but I had a look at it. I was actually really a big fan. And if anyone asked me in the last 5 or 6 years since Matt showed me that, and if they asked a simple question like, what's your investing philosophy? How do you find good companies? Often I would say, go read the Fundsmith kind of prospectus and go check out a couple of Terry Smith's annual letters. It's not the same thing. He's almost like the British version of Warren Buffett, albeit wildly less successful as it turned out. But his principles, his philosophy were solid. It was essentially kind of, coincidentally tied to my own. And his sort of 3 principles were buy good companies, which he defined as companies with high returns on capital and resilient business models and a few other things. Don't overpay, i.e. valuation is important, and then do nothing. That's kind of similar to my own approach. Maybe my definition of good companies was different to Terry's. And maybe I didn't put enough focus on valuation a long time ago. I absolutely do now. And then do nothing, like we both had in common. And it's just, to me, it's just self-evident. That's the way to generate alpha in the long term. And Terry was the Fundsmith was doing a great job, right? From 2010 at launch to 2021, they became one of the biggest asset managers in the UK. And I think they may have peaked at nearly £30 billion, which might sound like peanuts compared to American funds, but, quite a big deal. But they've quietly been hemorrhaging AUM, assets under management, over the last couple of years. They don't publish this, but here's a little picture that I put together a few days ago where I just got Claude to trawl through 7 or 8 years of Fundsmith annual letters and then pull out the AUM number. And if you're not on the YouTubes, essentially AUM climbed up to a peak of £28.7 billion in 2021. And it's now declined down to £16 billion. So that's a substantial haircut. And the kind of kicker on this, because I posted about this on X the other day, is Fundsmith's returns were positive. They didn't beat the market, but their returns were positive in 2025. But that was the biggest drop-off in assets under management. And so big loop. Now I come to my main point, which is active management just doesn't work. The incentives are misaligned. If you people ask me from time to time, Luke, will you manage my money? Because I'm leading the market by a handy margin and I've got all the kind of evidence there to prove it. And I would never manage other people's money. Like, case in point, 2022, my portfolio took a nearly 40% drawdown. So, I was nearly worth like half what I was worth in 2021. And the only person I had to convince that I'm still doing the right thing, stick to the plan, stick to the program, was myself. And if I was managing your money, you'd be quite justified in saying, what the F, Luke? Like, we're down like 40%. What are you doing about it? And my answer would be nothing. We're doing nothing. We're just going to let this play out, take a breath, come back in 6 months. But you're going to fire me. Like, you're going to want your money back. Or you can be asking, you're going to be making hell for me, either online or, in email. And you might even be getting your lawyers involved. Because you're like, this is, dereliction of duty. Why are you not doing something? And so this is why active management doesn't work, because the right answer is do nothing. And Terry, unfortunately, is in the news in the last week or two, because in his latest annual letter, essentially, he's like, BIGO companies don't overpay and now completely change the portfolio and invest in things we were never investing in before and start chasing momentum stocks. Because he's got to do something, because he's underperforming the market. The market's got bored of that. People have withdrawn their money and they're giving it to other managers or passive funds, or they're picking stocks. And like Terry's business is falling apart. And that's a problem because, he has staff and he has costs and like fixed costs. And if you don't have, if your assets under management are going down, well, the fees you're earning are going down and the whole business model starts to break. So Terry has illustrated it, because despite being highly principled and one of the best fund managers in the world over the last 15 years, well, say 10 of the last 15 years, he's been caught with his pants down because he's had a protracted period of underperformance, because he really wasn't in like the AI trade and a few other things like that have really driven returns. And as a consequence, he's had to start doing something, changing his approach, which is kind of time tested. And that's why that's a clear example of the incentives being misaligned. Now he's having to do stuff that I'm sure he does not believe in personally, just because the market's telling him.
So, bluntly, the moral of this story is what for our listeners?
Don't give your money to active managers. Doesn't matter what the track record is, doesn't matter how well they've done. You cannot, well, they say you can't buy conviction. My tweet kind of punchline was, turns out you can't durably sell conviction either. If you're invested in like this year's like all-star fund manager, at some point in the future, they're going to underperform, and you're not going to know, you're not going to learn anything from that other than, this guy made a mistake, and you're not building the skills as an investor. Either passive index trackers all the way, S&P, FTSE, keep it simple. There's no human making a decision. It's all just mechanical, following an index. Or pick stocks and, have a hand in the decision making yourself. Don't delegate your stock picking to someone who's going to, their objectives in picking that portfolio are not aligned with your objectives of making money in the long term.
That is a very valuable principle badge. I hope that kind of makes its way to a wide audience. It's not easy to parse through the delusions, especially with fancy ad marketing copy and all of these funds. Many of them have like a few fantastic years, and then, so thank you for that.
All right, let's get on to our stocks. And if like I said, index funds or pick stocks, and we pick stocks at Wall Street Wildlife. If you are just tuning in, like we're nearly 3 years in now, but we've been running the King of the Jungle Portfolio Challenge, where Krzysztof and I go head to head. We actually manage a real portfolio, real money each. The numbers aren't big. Our real portfolios are separate. King of the Jungle portfolios are becoming substantial. They're now 5 figures pretty much each. And we're seeing who outperforms the other. And between us and our community, we've got probably 35 different companies And for the last month or two, we've been going through every single company in all three of those portfolios and giving you guys like the headlines on what they do. Are they a good investment? What's the bear case? And we're essentially trying to attack and pull each other's stocks apart. So we're doing that today with Procept, Tesla, and Uber.
All right, Badge, let me tell you about Procept BioRobotics, ticker symbol PRCT. They make a surgical robot called Hydros. It treats enlarged prostates, which is a problem for 40 million American men. And if you've ever heard the adage, what do old guys talk about? They talk about their peeing business because this is a significant issue. The difference is that these robots use heat-free techniques guided by water, the water jet and ultrasound, but it makes a big difference between outcomes versus using heat. And so in order to do this, the surgeons need the sort of fundamental, call it unit, and then a single-use item that goes with each procedure. So you buy the robot up front, and then the hand piece has to be rebought. So classic razor and blade medtech. And I know you're very familiar with that, which is why I really want to talk to you about some of these deeper points. Here's the setup, though. The price is in the complete gutter. You could see we are near an all-time low, or especially over the last couple of years. And in the last couple of weeks, there's been some downgrades. Meanwhile, fundamentally, there have been improvements because the U.S. Medical Society guideline upgraded the aquablation technique, as in, yay, this is like a good thing. Plus, they also completed enrollment in a prostate cancer trial. I'll tell you more about that in a bit, and got an FDA approval for second prostate cancer approach. So fundamentally, things are going better. Prices dropping, downgrades are happening. That's when my ears start tingling even more. So here's the thing. Here's the other thing. There's a new CEO, and this CEO, from his previous experience, said we need to do the commercial rollout differently. We need to basically sell fewer units, but the ones we do sell, we need to charge a higher amount, and they need to go to better customers. Short term, that's definitely a blow to the numbers. Long term, it seems to me the obviously correct strategy. Since that shift has happened early in the year, the stock has obviously gone down. These earnings coming up on August 5th will be extraordinarily important to see whether or not the strategy has actually begun improving the fundamental metrics. You will see three pieces of evidence here. The blue lines, the blue bars, are revenue basically going steadily up and to the right. However, net income is still struggling. They're still losing money overall because the scale is still not big enough. But most important is that orange line you see where it's the procedures being done. Because again, razor blade model, right? The more procedures, the more you swap out the razor and the blade. You could see that it actually flatlined over the last 2 quarters at around 12,000 something procedures. This was going to be a known effect given that commercial pivot. So August 5th, what kind of news do we get? If it's like, we need more time, then the stock's going to drop even more. If we see a uptick or reacceleration, then the stock has potential to re-rate significantly higher. Should you buy Procept at these levels? My take is quite obvious. The potential here is the best it's been in maybe the company's history. If you don't want to take the risk, you wait until earnings, you see what the numbers are, you're going to pay a higher price for the stock, but it has a long, long way to re-rate completely. If you want to take more of a prospective gamble pre-earnings, you might take a little nibble, see how it goes. One thing, so that's one thing I do want to mention, Daj, in the context of King of the Jungle, in terms of how I'm handling this position. I bought my 3 shares, I believe, at around $35 a piece. So it's down 20-30%. I don't know. I can't remember the exact number. But I mentioned that because I was not tempted to add more. Or rather, I was tempted, but I refused the temptation. And that's because, and I think this is where retail goes wrong all the time. When the chart looks the way it does, I mean, it's a really steep downward slope. You keep potentially saying to yourself, but it was so much more expensive. It certainly has to be cheap now. But when I bought in, to take that little nibble size that I like to do, I already thought it was cheap. But look, here we are, and it's 30 whatever percent even cheaper. And even now, I'm refraining from adding because the technicals do not allow me to do that. And so I'm going to listen to the call, and I'm going to sit on my hands. And I have a suspicion that things are going to start really improving pretty soon.
This is a stock that we first heard about from Professor PS, I think, the world-renowned robotic surgeon who we interviewed about this time last year.
Well, I brought it to his attention, but he was well aware of it.
You're right.
Yeah,
that's right.
Yeah,
that's the first time you mentioned it.
Yeah, he was well aware.
But he had heard of it. Yeah, that's right.
Yeah. So I have a few. So let's go into the deep dive portion, Daj, because I really want to talk to you about this because I keep in the back of my mind. I know your success is to no small degree based on your long-term investment in Intuitive Surgical, which, if you get a play like that right and then ride it for the year, many, many years, the returns could be absolutely astounding. So let's talk about it, big picture first. Prostate enlargement, again, is a serious issue for so many men, and it affects sexuality, affects your ability to pee or not pee. As men get older, it just is a really nasty thing. And this particular technique appears to really be better than the old school methods. So that's one. Now, all of a sudden, you have the possibility of also layering on top of that prostate cancer. That basically there's these 2 trials that Procept is applying for. One is instead of radically removing the prostate, is our method better for treating cancer? That's one. And the second one is comparing the usual advice often heard is we wait and watch your prostate and don't do anything. Whereas Procept is saying that's kind of uncomfortable position to be in, where our technique is actually quite effective at removing these low to medium risk prostate cancers. That's not going to be FDA approved still for some years, but it is a kind of optionality that, the market will begin pricing in once the data gets more and more clear. So that's multiple. So basically the market is quite big. That's point one. That's why I'm interested in this. 2, this thing about the pivot, commercial pivot, I know, having studied the markets now for some time, I know that eventually the market gets tired and impatient, right? This pro gets brought into this company with experience at a turnaround doing exactly this. He took a struggling company from whatever millions in sales up to $1 billion valuation by running this playbook. He's like, no, you don't just sell these things as many as you can and hope for the best, right? Giving discounts and all kinds of marketing incentives. No, you get rid of all that. You charge the higher price because the mechanism is worth having, and you aim for the best hospitals and the best surgeons. You install surgery leaders that then make sure the device is properly used. You go slower, but all the numbers, the margins, the average selling price begin going up. Right. And it's kind of proof of concept. And then it grows more slowly, but more effectively. And we're exactly at that point in the trajectory where the market is like, man, the results are, it's not going as quickly as we want, so we're going to sell off the stock. And to some extent, when you're still losing money, you don't have infinite amount of time, so there's pressure here. And that's why, in many ways, I'm saying in that short I delivered, these earnings, August 5th, if you're at all interested in this company, I would tune into those earnings to see just how effective this commercial turnaround has been. If there's hiccups, it's not gonna be pretty in the short term. But at right now, the opportunity, I think, is the odds are stacked in its favor, I would say.
Yeah, it's interesting. Like, I'm just looking at some of the numbers on Fiscal AI right now. Oh, by the way, like Fiscal.ai, our favorite stock research tool. Check out fiscal.ai/wildlife for a 1-week free trial. We use it all the time, and I'm using it right now to look at Procept. So there is something going on in the numbers. My first sort of glance was like, is what Krzysztof says true? Because the company is spending a ton on SG&A, like selling and admin expenses, which is like in that marketing and like sales incentives and stuff like that is in that line. So like, is it true that this guy's come in and pivoted the business model? Are they still giving these incentives? Because that number's going up. But in the very latest, if you drill down from like annual to quarterly, in the very latest quarterly numbers, something seems to be slowing down. Like sales to revenue, the growth is kind of, is inflecting. So maybe there is something there. I mean, it's early in that change, I suppose. And this stuff could take a long time to play out.
Yeah, so if I may, we've got guidance. Basically, the CEO said second half of the year we're maintaining guidance, and the first half is going to be painful. The second half is where you'll see the effects of the pivot. I mean, so far in the first quarter, the numbers came true. The margins stayed high. The average selling price went up. It's just that the scale, everything depends on scale. You know this better than anyone. For the razor blade model to start working, you just need more of these things installed. And so when you're installing fewer of them by design, it's that flatlining is going to look bad, because all of a sudden you're still paying people. You're still, it's a pain. It's a growing pain.
There's about, like, this is not, in my mind, this is not like intuitive. Like, I know they're in the same sort of field. My bull case for intuitive was always, like, they started actually doing prostatectomies. So like the much more invasive version of what you're describing, where like the prostate is completely removed. But they branched over a decade. They branched from that into lots of other surgeries, and now they're in general surgery, which is like everything. So they can't do everything. You don't use the intuitive for like brain surgery and some things, but every time they add like a new procedure, or hospitals start adopting for a new procedure, that's like a huge chunk of serviceable addressable market. And I don't know much about Procept, but I guess this, if their thing is about this like aquablation, like they are, I'm sure prostate is a huge market, but they're in this like niche, and probably their tools and techniques would be, it would be hard to find applicability for those specific things in other parts of the body. But they, arguably they're like intuitive. They're just very, very, very early in the journey, and gross margins are very similar for intuitive and Procept. It's just Procept as a younger company falls down on operating margin, which is like massively negative, and it's still mostly because they're spending so much on like marketing, sales, and those costs.
I mean, originally what got me interested in this is that the CEO or former CEO of Intuitive Surgical bought a bunch of shares. And so, that perked my ears up. it's at $1 billion enterprise value right now. So this is why I'm interested in it. It doesn't need any other. Prostate and prostate cancer is plenty. They just need to be the best at doing that. And the medical evidence is coming in saying yes. And now it is just this matter of, going through all of the issues with the complexities of getting a hospital to pay up front for an expensive thing, training people, and going slower and steadier than faster and willy-nilly. So at this moment, we got to watch that the growth holds above 35%, the margins stay high or hit 65% or better. We don't walk back the revenue guidance that was 390 to 410 million. And if we hear that, I'm going to either, I imagine if we hear that, the stock's going to go up quite a bit. If we hear anything other than that, we're going to be getting it even cheaper. And then it's going to be another decision point about, well, when exactly might that transition happen? And then I'd probably resort to the technicals and wait until the market starts buying.
If I look at your position in the King of the Jungle, so you've got like a 0.5% allocation. That's pretty small for you. But that's good, right? Because you've got this, very early fragile company that's in difficulty. Why not have it as a small position? It gives you like motivation to watch it. You're also exhibiting like a good investor behavior here because you're down like more than 40% on that position. But you're not just going, oh, I'm down, I'm going to add to my loser. What you're saying, I'm hearing you clearly, is like, I know why this company is in trouble. I know these signals, like these things I'm looking for. I'm not going to like panic buy, panic sell. I've just now got like my cliff notes. And when the next quarterly results come out, the ones after that, I've got, a way to check and validate. And maybe then I will add or sell or something. But it's based on execution driven by research.
Right, exactly. Couple of just small notes there. I don't think this company is in trouble. That's, I think, overstating it. The stock is in trouble. I mean, the stock, going from 70 to 20, that's bad. But if I really, really lean on what makes me a good investor over these many years, it's because it's exactly when a stock is in trouble. But I don't, to your point, either panic and buy because of an anchoring bias or sell because I'm frustrated. But instead, I do the deep diligence, and I, on my calendar, put this August 5th earnings call. If I strike in that correct window, the gains can be so hugely market beating. But these are the steps you need to follow to be in the right place at the right time, and it's hard. And by the way, as you were saying that, the merits of doing this podcast, exactly. We say this all the time, and hopefully our Patreons can take advantage of this. Like buying that nibble position, having it on the watch list, having it in the portfolio, and then being disciplined about when to strike or when not to strike through conversation, through this forced public performance or whatever it is we do. That's how you do it.
That's interesting because I did want to comment on something there as well you've reminded me of. Like, I posted a question on the Patreon of last week to say, like, we're going quite slow with this King of the Jungle review. We've got 30 plus stocks to get through. What do you guys think? Should we do more? And actually there were 2 or 3 of our Patreons said, yeah, try and do like 5 or 6 stocks per episode. But just like what you just said, I get a lot of value out of actually going deeper and just, refreshing my DD as I did with Tesla and Uber 2 days ago, and then having the conversation with you and letting that conversation breathe. And if we try and power through stuff too quickly, like, I think I'll get less out of it. We'll just be ticking a box rather than really understanding what's going on. So I think we could probably disregard that feedback and stick to like a smaller number and have better quality conversations. Like listen to us on 2x speed if it's boring.
Yeah, right. And of course, you and I talk a lot all the time about, getting how do we increase our YouTube subscribers and so forth. And it's such a counterintuitive thing because we know from our numbers the things that have been watched the most are the 90-second, 2-minute clips. But really, in 2 minutes, I mean, how you could repeat what everybody is saying in the public forums, but you really can't possibly learn the complexity. So I think this is the right move. So anyway, should you buy Procept? It's an interesting question. You are kind of a prime potential investor in this, given your experience. I am telling you now, Badge, to really I would encourage you to put this on your watch list. However you handle that, whether literally on a watch list or buy one share and put the earnings call on August 5th, because this has real potential.
Yeah, that's fair. Yeah, and I feel like I know a little bit about this industry, and I much prefer like medical devices to biotech because I do not understand that stuff at all. So yeah, consider it on my watch list. You are my watch list for stocks like this. If you suddenly buy, I'll see that because you'll tell Beaver I bought this thing, and I'll go, okay, I need to have a proper look at this.
Awesome. All right, tell us about Tesla and Uber, I suppose, at the same time.
I mean, they're obviously completely different companies doing totally different things, but they kind of go hand in hand. You own Tesla? I know you own 2 Teslas. Do you own the stock today?
Yeah, it's odd. In my King of the Jungle portfolio, I bought 0.1 of a share, and that was one of my first purchases, and I haven't touched it.
And is it in your real, your actual money portfolio? Do you own Tesla?
In my real portfolio, it's one of my tiny baby watch list stocks. So
you have been a bigger owner in the past, and
I was a huge owner. Yes.
Yeah. Okay. So I mind myself as we have the conversation. All right, but we do have to do the 90-second ES for YouTube. So let's start with that, and then we can actually have a quality conversation. Tesla, do I really have to tell you what Tesla does? Right, they are the world's most valuable automaker, but the market now prices them as an AI autonomy company, not a car company. 3 main pillars, but to their revenues. We only really see 2 of these in the numbers today. EVs, like electric vehicles, like the car on my driveway and the 2 cars on your driveway in Austin. And that's the cash engine today. It's directionally about half of their revenues. No, more than half of their revenues. Energy storage, which they bought Solar Edge somewhat controversially years ago, but they do have a solar and battery for grid scale, but also for the home. And that's fast growing and it's higher margin. And then the third pillar you don't see in the numbers because it's really just optionality stuff today, I think is coming fast. And it's probably the most interesting part of the company. And that's Robotaxi and full self-driving plus the Optimus humanoid robot thing. So the valuation, it's about a $1.5 trillion company today, Tesla, the whole company, which if you look at it on a forward earnings basis is 180 times earnings. And this is a mature company, so you don't expect to see you expect to see 180 times earnings for tiny little companies that are just starting to generate earnings. You don't expect that for a mature $1 trillion plus company. But that is the case for Tesla. And it's because they're trading all this future stuff. Everybody's drinking the Musk Kool-Aid on robots and FSD and Robotaxi. Most recent quarter, Q2 2026. A couple of things on this chart. Probably the one to focus on. So we've got the stacked bar chart. You can see automotive, the big sort of bluey looking, greeny looking bar is the massive amount of automotive revenues, really drives revenues. It's down, revenues were down quarter over quarter, year over year, they're up nicely. But the line on there, really, the numbers are generated by deliveries, production and deliveries of vehicles, which is mostly the Model 3 and the Model Y. that has been trending down over the last couple of quarters to do with, Musk hasn't made any friends on social media, and his, involvement in politics. People stopped buying the cars, frankly, because of the Musk effect. That's now inflected back to the positive on like a year-over-year basis. And deliveries are up. In the most, I don't show quarterly on here, this is annual, but on the most recent quarter, 480,000 deliveries, up 25% year-over-year, which happened to be above consensus. So, maybe people are forgetting the Musk effect, and maybe now the company is being driven by what it's doing, not what its founder and CEO is saying. Valuation is the bear case. Right? And it all just comes down to, do you believe the story? And there's another facet to the story as well, which is like the rumored merger with SpaceX, which owns XAI, which is like Grok and other stuff. So, and FSD, like, so you have always bitched and moaned that you've got, like, both your cars are hardware 3, so like prior generation of hardware. And where's like, Elon, where's my FSD? They're now rolling out FSD Lite. That's probably like installed on your car, waiting for you when you get back to Austin from Italy. Be interesting to see what FSD Lite is like. But FSD, Max on the hardware 4 cars is getting great reviews. I had to go in January for a whole month. I had a car with FSD. It is mind-blowing. It is going to change the world, but they're not the only automotive manufacturer doing FSD. They're not the only manufacturer doing Robotaxi either. They're pretty limited in their little, like, geographically constrained pilots, whereas you've got Waymo, which is like a spin-out of Google Alphabet, and they're running like truly unsupervised rides across like a whole bunch of geographies and adding more cities all the time. So, the valuation of Tesla is driven by FSD and Robotaxi to a large extent. People, can forget that they're not the leader in this. Like, Waymo is kicking their butt. And in China, where the regulations are totally different, I get the impression, or who knows, like, what the reality on the ground is, that there's some very advanced FSD, Robotaxi offerings from a whole bunch of companies. So that's the bear case, like, valued on this stuff that may or may not be legit. Where are you on this?
I legitimately think the bigger case here that would involve me in Tesla as an investor again has to do more with the ramp of the Optimus robot, because seeing what AI could do and then putting AI into a physical entity. Yeah, as an investor for myself, I'm legitimately waiting for the Optimus ramp. And that's because one of the former factories is being converted to that. And I could imaginatively take Elon's word. I suppose that's going to be the world's most popular or I don't know how to phrase this, the biggest product ever made. And so I'm discounting to a large extent even the auto stuff. I'm just saying, like, when is the robot going to be a thing that a normal-ish household could potentially buy? And given that I have to discredit Musk, I can't any longer believe things he says as true. If he says it's going to be out next year, that might be, 2 years, 3 years? And that's a long time to be in the market. So that's why I'm not, all this stuff about the cars, I mean, I don't know. I imagine the market has priced that in, but I'm not eager to add here.
Yeah, and let's just sort of ground it in our own life experience. Like, would you, like, have a Optimus robot in your house at home?
Sure. I'm a Roomba guy. When the Roomba stuff was happening, I got me the Roombas.
But what about, say, like, even putting aside like the cost of it, what about like the privacy aspect? You then have got like audio and video, like persistent capture from around your house. The thing like walk into the bathroom while you're sat on the loo, and then this is all in like a Musk data center and Grok is training on, all that stuff. acceptable.
I mean, I don't know. What's the word? I don't know. The robot might capture monkey snacking on a banana. What else? You know, I live a very angelic, pure, clean life. Just me and my bananas. So I don't. You know what? Everybody, I was gonna say, I'm not as concerned as that as you. But then I remembered the Black Mirror episodes, and you're right. I wouldn't get one of these until I rewatch Black Mirror, and then I might not get it at all.
Okay, I mean, don't judge my question, but by my thinking by my question. I would 100% have like a bunch of these in my house if I could afford it, and like a bit like, you know, I use Google and I didn't switch to Brave and various other things because if I get utility out of this thing. Like, to be honest, screw my privacy. I'm not doing anything I'm particularly worried about. And if someone uses that data to market more aggressively to me, then, okay, that's interesting, I suppose. But if things can like freaking load and unload the dishwasher and fold the washing and stuff, bring it on.
Yeah, rake the leaves and yeah, absolutely. So anyway, going back to Tesla, I don't see any compelling reason to invest now. And I would say, really, again, let the price do the talking. And once we see that there's going to be some inflection point because the robot thing and all these confluences are going to start to happen, we'll see it. And so why now?
Yeah. Agree. It's so hard. You can't do any kind of sensible financial analysis on Tesla. Get Kathy Wood's like random projections because she's in Elon's back pocket. Like it just doesn't make sense. You have to. To me, this is like we always talk about narrative versus numbers, and this is 100% like a narrative decision. But the trouble with that is, you know, if you come at it from the perspective of a technical analyst and you're looking for, you know, something in the price chart, because it's so narrative driven, like a story will break. And the stock will like, you know, double overnight because all the narrative investors are like, shit, Robotaxi is really here. And they're scaling it like right now because Elon tweeted something.
But let me break that down just a little more subtly. It's a what? What's the market cap? $1 trillion something?
Yeah, 1.5 trillion. Yeah.
Okay, so we know it's actually not literally going to double overnight. Right? It's not going to go up 100%, $1 trillion from Monday to Tuesday. I mean, that would take something truly extraordinary. What would happen is even to not to play devil's advocate, to take your point, it could happen very, very quickly. But even then, right, we'll get the piece of news, the stock might go up, let's say, even 20%. That'd still be massive for this market cap. Then you go in and you still ride it for another few trillion as NVIDIA did.
I've got about 4.5%, I think, in both my King of the Jungle and my retirement portfolio. So I'm just kind of in and I'm holding my nose on the numbers that don't make sense.
Wait, is this another one that we both have in King of the Jungle? Or was I first? And then you...
I mean, I think I've probably owned it the longest because I was in Tesla in 2014, I think. Oh, in King of the Jungle, you've ceded it to me. So only I own it. You don't.
Wait, only you own it? No, I know I own it, but...
Oh, no, you do. 0.4%. It's mostly me. I'm like 4.6%, which is a massive position to me.
All right. So how's Tesla tying to Uber? Because I know Uber was the talk of the town for a little while. I know you were quite interested in this as a investment opportunity. I sat there and I tried to understand, and I think I understood a bunch, but I don't understand anymore. So
again, there's another one. Like, I shouldn't have to explain what Uber does, but for the YouTubes, let's do that, and then we'll have the interesting conversation. So, who are Uber? Essentially, the world's largest ride-hailing and delivery, like logistics and couriering, stuff like that, company. An asset-light marketplace, albeit maybe that's not entirely true in the future, that matches riders and eaters with drivers. So it's positioning itself to own like demand and logistics. And they've got like a lovely software platform that's super intuitive, easy to use. Even my mum and dad use Uber. They want to own like the software, the demand, like the people who want to ride. They don't want to own the cars. Again, though, maybe that's changing as of some very recent news. The whole model is about like network density and utilization. So, if they have enough demand in a geographical area, they can then onboard supply from actual human drivers and existing like taxi firms and restaurants and supermarkets, and they can onboard supply from, in the future, like Robotaxi providers, like in theory, Tesla, Waymo, and many, many, many other Robotaxi platforms, many of which are powered by NVIDIA Drive. And so that's the idea, like they're trying to sit in the middle. Most recent quarter was strong. Gross bookings are up 25% year over year to $53.7 billion. Guidance is good, sort of guiding for sort of 20%, 22% growth. And like the story is Uber's focus on being the aggregator of everyone else's demand, that in the future, everybody else's robo-taxis. And they do have partnerships with like a whole bunch of robo-taxi firms that you probably wouldn't, like Lucid, Motional, Rivian, Zoox, Pony AI. So, they're trying to get themselves in the middle. The bear case is, well, actually, let's have a look at the piece of news. Waymo and Uber break up. So when I bought into Uber quite recently, like maybe 6 or 7 months ago, and I added to my position as well, my position was everything I just said about them being like the aggregator for demand. At the time I bought, they did not have Tesla Robotaxi, because Tesla built their own app. They did have Waymo in like limited surveillance in a few markets. So you could book a Waymo via the Uber app. And my sort of base assumption is they would probably win everybody else, because everybody else is kind of nobody's compared in terms of Robotaxi compared to Tesla and Waymo. Well, the news of a couple of weeks ago broke that Waymo are going their own. They're not listing Waymo vehicles on the Uber app. They have like their own app, and they're going to focus on that. So that kind of damages my thesis quite badly. That could be an existential risk if like everybody ends up, if like the market pivots from human drivers eventually to robo-taxis in the main, other than like certain niche journeys, like Uber could lose the whole market. And that's a big, big problem. So that is kind of the bear case. When I was researching this, there's quite an interesting sort of stack, robo-taxi stack, that was described by their CFO, Balaji Krishnamurthy. And I used AI just to turn his words into quite a nice graphic. Let me just share this, and then we can have a debate. I'm going to read bits of what he said, but if you're on the YouTube, you can see this pretty picture. He said, the CFO said, I think there are going to be 5 clear layers with different kind of permutations with different partners. So in our mind, the stack is a marketplace, which is like the consumer-facing bit at the top. Then you've got the autonomous vehicle software players. Then you've got third layer, like the manufacturers who actually make the cars. Then the fourth layer, you've got like the infrastructure that supports that. So it's like charging stations, maintenance, cleaning, charging, things like that. And then the fifth layer is financing. Like almost like the idea is maybe these will be like REITs, real estate investment trusts, and you'll have like, a fleet of 1,000 cars owned by a REIT in a certain area, and you might be able to invest in that, and that raises money to like buy more cars if these things are like profit generating, like little vehicles on the road. So quite a nice articulation of the stack that I don't disagree with. And what the CFO said is like, our focus is on the top layer, the marketplace, but we're also going to partner across the rest of the stack. So again, I think that makes sense in the round. And I like that they're focused on the top, the marketplace. That is my thesis. But it doesn't mitigate the bear case, which is maybe they lose the marketplace if like Waymo goes that direction and if others do too. So what's your views?
Badge, this is the question I had fundamentally, and I don't know if I'm any smarter after hearing what you just said, or any not smart, any more capable of making the decision here. I might be laughed out of the room in some of the comments we get because maybe my perception of this is so naive and so wrong. I do not understand legitimately how Uber is in this sense any different from sort of Duolingo as we were talking about, like in the crossroads of what I would say very obvious disruption. Like if Tesla, and we know Musk's competitive shark teeth, like he's going to try to kill everything around him. Why would he ever have anything to do with this marketplace infrastructure if he could do it himself or is already doing it himself? If Google is already breaking up, then what's left? Legitimately, what's going to be left for Uber if the two main gorillas are like, we're not playing ball? Is the market that big with all the little other competitors to justify the current market cap? Is that a dumb question?
No, it's the right question to ask. But I think I'd argue with your premise that these are like the main gorillas. Because if we just look at, like, forget Robotaxi and everything else, let's just look at like how many cars are on the road today and what proportion of those are, let's say, Teslas versus Waymos versus everything else, you know, Toyotas and what like 100 manufacturers. Like I know Uber is like the dominant car manufacturer in the world today, but they're not the majority of cars on the road, right? Maybe in cities, I don't know, 1 in 10 cars you might see is like is a Tesla. So, and I'm sure that's going to grow, and like they're an EV leader. I don't see them ever being, you know, so dominant that like every car is a Tesla. Do you buy that?
No, I don't buy that. And simultaneously, I'm thinking of what happened when Amazon, the gorilla, showed up, and all the little guys, like there was so many periods of time where the little bookstores were being pressured and margin, you know, race to the bottom line happened. And you can't, even though the gorilla might not end up dominating everything, the pressure that the gorilla makes everyone feel makes me think that the market, in order to continue bidding up the value of Uber, must somehow say that gorilla effect is not going to be bad enough. But we also know the market's pricing things out like 3 to 5 years. So, and correct me if I'm wrong, the way I understand this thesis is based on network effect. And so my understanding of network effect is it's the spiraling ball. The bigger you are, the bigger you get, and at some point you can't end up competing. So if I try to imagine Austin's roads 3 years from now, and Austin it happens to be where two of the gorillas are playing, it's hard for me to imagine company C, D, and E making any substantial inroads against Tesla and Google.
Just so we're clear, like you think in the future, 10 years time, a large majority of vehicles on the road will be Teslas, and like Mercedes and Toyota, they just kind of won't. They'll be de minimis. They'll be rare.
Maybe this is where I'm confusing some things, because I'm thinking is there a difference between wanting a ride through the network versus just all the cars on the road? Like, so I think, there will be other cars on the road, but if I'm at a corner waiting for a ride, I don't care that there's a Toyota and a Mercedes. I'm going to either press the Tesla or Google button, probably.
Put it this way, right? And actually, just as context as well, we're focusing on rides, but like mobility rides in the last 12 months was about $30 billion of revenue at Uber. Delivery, like logistics stuff, food and everything else, that was $18.5 billion. So, you know, not into like a third, 2/3, maybe like about 2/5 of the overall revenue. So that's not insubstantial. And I think there's a different argument to be had around logistics and delivery. Is that I don't think Tesla are going to get delivering food. But if we focus on mobility, like okay, like let's look at another graphic. So here's a little pretty picture of from the most recent Uber earnings of all the partnerships they have. And probably the one that, like, you've got Baidu in the middle there and Pony AI. Like, they are two quite significant Chinese AV, like FSD type manufacturers. But the one that's important on there to me is NVIDIA, because NVIDIA Drive is going to sit in like all the German cars, and NVIDIA, they're probably not going to win the race to full FSD, but they're not going to be more than like 6 months behind Waymo and Tesla, I think. Like, it just strikes me as I look across this picture, Lucid, Rivian, all these other manufacturers, like there's enough supply of autonomous vehicles and like Robotaxi capable cars that there's going to be plenty of space for these guys. And the other thing that's important is like the competition is really good, because that will force like prices down, because without competition, like prices will stay artificially high. And so this is great for consumers. This is great for my parents, because I'll have more options for like a robo-taxi in their local area. And as you said, right, you just want to get from A to B. You don't care whether a Tesla shows up or a Mercedes shows up or what it might be. You just want to do the journey. So like Uber's not a unique advantage. There's nothing special about it. Like, it is, I wouldn't say it's like a Duolingo, but I would say it's like an Airbnb in that respect. Like, their advantage is that they are capital light, and they are, in my mind, they're like, would you really want more than 2 robo-taxi apps on your phone? Or 2, I want to go somewhere. In the UK, I've got Uber and Bolt. And when I'm in the States for ski season, I uninstall Bolt and I install Lyft. I don't want more than 2. And 2 is enough that if I'm trying to get home from like a poker game, I'll price check 2 apps. I don't want to price check 3 apps or more, because that's just becomes then like an administrative pain in the ass. And so my kind of thesis here is that most people in the market will have Uber plus another app. And if in the US, maybe it becomes like Uber and Tesla, or Uber and Waymo. Will it become Waymo and Tesla? Maybe if you're in one of these cities that have high density. But I don't know, man. I think people travel, and Uber is everywhere already. Like, that's the app you're going to keep.
Yeah, I'd buy that. Then the question becomes valuation. And I sold my Airbnb shares the moment I got them through the offering. And I think that was the correct call if I look at the chart. I haven't done the work. I don't know enough, but about can it remain a good investment from these levels? For me to be interested in this, knowing there are these 2 gorillas, the question is, what are the network effects beyond good to justify the competition? So what's the edge? What's the edge that an investor might have? Just the simple fact of, all the other remaining players are big enough.
I suppose it's, without spending ages going through all the numbers, it's kind of a distressed investment at the moment. I think it's probably undervalued because there's a lot of pessimism built into the stock. And as I look at $150 billion companies, this ain't some tiny company. It is expensive. But I don't know. I think it's got an opportunity. Let's put it this way: like, in the far future, as the cost of robotaxi comes down, demand will explode, because if it costs you like $50 to get to the office today, if in the future you can do that journey for like $10, you're going to do that journey like all the time, right? Suddenly it's cheaper than public transport, and it's so much nicer and convenient and So if if my thesis holds that Uber will always be like the other app on your phone, and if demand like 10x's, 100x's, 1,000x's,
Krzysztof to come back.
and we haven't even talked about like delivery and logistics, I think they're well placed to be like a future $1 trillion company. So again, this is like a narrative, not a numbers argument. I think the narrative is potentially quite strong here.
I buy that. I could see though when this will happen, like in 5 years, I could see the quality of auto rides being so much superior to driving your own self, both logistically and financially, that eventually, right, it's going to be illegal to drive. It's going to be illegal for humans to drive. So,
we talked about Airbnb, and maybe there's actually a slightly different analogy, because you've got, say, booking.com. I don't know if you use that very often. You've got, all these hotels and like Hire and everybody else, like they have their own website to sell their hotels, but they also list them on booking.com and hotels.com and all these aggregator sites. And they actually, they offer discounts via those sites. And it all, like the business model is win-win. It makes sense. Like the hotels.com makes some money. I think they're owned by Expedia, I think. The hotel makes money because it sells more units and it has less, rooms vacant for any given night. And the customer gets value because they go to one place and they can see all the demand and they can quickly, find a hotel that suits them. And it's kind of that model, I think. Like there's a room for that, for Uber to exist, even though there's like a Hire.com. It's kind of that argument, I think.
Yeah, I buy that. I remain unsure from the investor standpoint whether at this moment, at this valuation, is it justified? Is it not justified? So, but that's ignorance, mostly ignorance, because I don't. Right. I mean, when you're dealing with narrative, you could throw, well, yeah, it's going to be 100 times bigger than it is today, and
Yeah, and I'm not trying to be that guy. Like I've just talked about Tesla and Uber. They're both like a narrative story as investments, and I'm not trying to be that guy who's like, oh yeah, these are like $100 trillion companies in the future. I'm trying to be grounded and realistic. I'm just trying to look at the world through the eyes of what would I want to buy? I would have an Optimus. I do want to take like a $10 taxi ride that's cheaper than like a bus. This is just kind of the world as I see it in the future.
Since I have AST on my mind a lot these days,
You owe us a 4-hour episode on ASTS.
It's coming. Hey, you're involved. So it does make sense to me that you do always want a second alternative, that a world with a monopoly or duopoly is not one we really want to live in. So I don't know if the analogy is perhaps Uber will be the AST of autonomy against the Tesla and Googles of the world.
That actually is a good analogy, right? Because ASTS is allowing like the Vodafones and the AT&Ts to be more effective, provide a better service, utilize their CapEx better in remote areas. And I suppose that's what Uber's doing for the automobile manufacturers and the Robotaxi platform providers.
Yeah, I totally buy that. Except AST has a whole nother, right. Okay.
All right, long episode, bring us home, but you are going to tell us about EOS.
All right, Badge, here's the thing. I said a lot about this on our Patreon already, so I feel like I don't want to rehash everything. Check out that episode, join up if you want that. Here's the high level. I spent a stupid amount of time dealing with this over the last 4 days. EOS wanted to raise 150 million, Badge, in order to participate in the joint venture that's this sort of financing insurance platform to basically help all the utilities and all the people that want batteries, make it easier for them to buy them, right? So EOS says, let's raise we want to raise $150 million. They could have done that the basic, simple way. You subject owners to some dilution, but it's not a huge number now relative to where we're at, and it would have been a done deal. But as far as I understand, they wanted actually to allow non-institutional holders to get a better price. 548, I believe, or 541, one of those, as the price at which you'll be able to buy more EOS shares in proportion to how many you already have. So there was a floor, right? At the time, the stock, I believe when this was announced, the stock was like $9 or something. So the floor was quite lower. And on top of that, you would also get warrants. Lo and behold, this has been the most disastrous price killing offering, or I haven't actually lived through an offering before. So this is my first go around. Most people are stupidly confused because the actual mechanics of this are wildly bewildering for the following reasons. There's new options change involved. All of a sudden you have these new rights offerings which you could buy or sell. How do you exercise them? Well, it turns out you actually literally need to call your broker. Some brokers are saying this date. Other brokers are saying that date. Other brokers are saying we don't have any of this, right? It's a massive, massive disaster. And on top of it, turns out the efficient market figured out that if you sell EOS shares, you drive down the price. That basically drives down the offerings, and you'll be able to buy the rights for much cheaper, plus warrants, right? So what did the market do? It basically killed the share price of EOS. So it's now, I believe, $4.40, whole dollar below the floor, right? Wiping out massive amounts of value. And so now people are saying, well, why should I buy? Why should I exercise the shares for 548 if I could buy it on the market for 440? There is an actual answer for this, Badge. The correct answer is it might still be worth it because the warrants themselves are 10 years. So you're getting essentially an option that's 10 years out as opposed to merely 1 or 2 on the options chain. And basic options math is suggesting that the value of those warrants should be mathematically, logically higher than what the 2-year leaps are selling for. So they might be something like $2.50 or $3 per warrant. So when you do the math, it seems at the moment, per my understanding, the actual mathematical floor for is this a good deal or not is about $4.05 per share. But yet another complication. Once the warrants are released, they also become tradable. And so it becomes legitimately unclear whether if you want to own more of EOS to participate, one, help the company because they are trying to raise money, and secondly, because you do believe in the long-term future, 10 years out, should you just buy the commons and wait for the warrants until they're out? Or should you take advantage of the rights you were delivered? Right now, let me make it more clear for our listeners. In Monkey's King of the Jungle portfolio, I have 250 of these rights. That equates to about $94 if I want to exercise them all and get, I believe, 17 shares and however many warrants. And I'm sitting here thinking, I'm not sure what to do. And in the King of the Jungle portfolio, I'm guessing that I will actually exercise these rights. It'll be a learning experiment, really educational, really, because if I'm right about the company, 10 years from now, those warrants might really pay off big time. And I have currently in King of the Jungle, 630 in cash. I was legitimately thinking of buying EOS shares because I think they've fallen too far below their intrinsic value due to these crazy machinations. So I'm probably going to exercise those rights in King of the Jungle. However, in my real world portfolio, where I have way more EOS shares I'm over allocated to them, I'm probably just going to sell these rights, which at the moment are worth peanuts. Like they're 4 cents, they're basically about 4 cents per right, which fell from about 20 cents when they were initially offered. So what a disaster.
I mean, you've sort of portrayed it as, what, like gross incompetence by the CFO? Is that?
I wish it were that simple, but here's the thing. Help me understand this. The people involved in this include the most brilliant, financing minds in the world. They're the Cerberus and the people on the board, and like, these are not dummies. And this is part of the confusion. Like, did they really overlook the inevitable arbitrage that was involved? Maybe. Or maybe they're sitting there saying somehow it's to our advantage to be able to, gobble up more shares at these cheap prices I don't know. It's actually so far beyond my pay grade to legitimately offer any advice or any understanding, because most people are like, what the hell? I don't think it's incompetence per se. I think it might be complex system doing what a complex system does and finding, like, eventually teasing out the variables and being like, oh, you didn't think of this.
Probably a reason why most companies don't do it this way, right? If they want to raise capital, most companies just issue new stock.
Right. Yeah. And there is a kind of death spiral effect right now, but I had to go back to land this. I had to go back in my thinking to the fundamentals. What's happening on the ground? The orders are coming in. The manufacturing is scaling. We're going to get a very important update on the call, about the nuts and bolts. If that is still truly intact, I think this is potentially a real bottom in terms of price. Fingers crossed.
Let us know on the Patreon, which is wallstreetwildlife.com, what you actually end up doing. And then I'll probably dumbly just mirror that because I got my EOS option.
Yeah, last thing I want to say to our listeners in the audience, in a way, I want to say, like, I'm sorry that this EOS path has walked in us as investors into this sort of unforeseen complexity beyond what's reasonable. I don't think anybody had this on their bingo card. I don't think anybody, in hindsight, deserved this, so to speak. And as a sort of counter argument, if we were diluted for another 150 million, that would have been like, yeah, you diluted us again. But that probably would have been the more reasonable path, seeing what has happened. We'll revisit, it's going to be interesting. We will revisit this, like, let's say a year from now or 2 years from now, when in King of the Jungle portfolio, I'm probably going to have those warrants. And it'll be interesting to track, because that's going to be a next educational tier. Like, Monkey now has these crazy warrants.
That we're like learning in public, right? That's what we're all about. We're not about like blagging it, making up the numbers, deleting the shit that doesn't look good in the future. We're just doing this transparently. We're both 20 plus years as investors. I'm coming up on my 23rd year next month. I'm still learning stuff every day, pretty much. That's what it's all about.
Well, yeah, well said. I do one urgent thing, though, practical speaking. If you're an EOS investor, this episode for our patrons will land on Wednesday or Thursday, right? July, that would make it what, July 15th, 16th? But on the YouTubes, it won't be out till next Sunday. If you're hearing this on Patreon and you haven't looked at your portfolio, you actually have to call your broker, and you will be given some date that God knows what that is. And you actually have to make a decision to either sell what's left of the value of the rights or to exercise them. Otherwise, they literally disappear and you will be left with nothing.
Good warning. Thanks. I'll go and check my own broker immediately after this episode.
On Robinhood, it's it's going through chat, and the guy I was talking to had no idea what any of this was about and had to talk to, some other guy. And it's like, oh my God.
All right, so this has been a very long episode. But before we close, let's once again thank our sponsor, partner, affiliate, Fiscal.ai. Big fans of the stock. We used it a ton in today's episode, in prep and while running the episode live. If you want that complete financial data, use our link, fiscal.ai/wildlife, for your first week of Fiscal Pro free and a 15% discount if you upgrade. Are you ready to become a beast of an investor? That stuff doesn't work on board. He's saying yes. His journey starts. Yeah.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.